Hey traders, Nick Shaheen here looking at Caterpillar, CAT. Highly disappointing stock from the standpoint of it shows promise and then it fizzles. It's in the line of fire of the China headlines. It was at least more so last year. This year it's kind of like falling behind. Maybe people have given up on it. Here we're looking at a short-term chart, a couple hours every tick. So over the weekend, or actually I should say last Friday, it was on CNBC. I think it was Options Action, and I had some beef with their trade there. By the way, I have no position in it, and it's not like they hurt my feelings by saying short it. I do have beef with A, why short it, and B, how to short it, with both their suggestion. Now, Carter Worth, I think, was the guy on there, and he's a technician for sure. But what I failed is, I've never seen him put volume on there. Not so much as like how much, but where, like a volume profile. He speaks of patterns on lines and draw the pattern this way or that way, and he never puts in, that I've seen, on the left side or a right side where the volume happens. So there's no volume profile to tell you which ticks matter more than others. I've stopped watching ticks a long time ago, and I watch the ticks that matter, and not every tick is the same. So it all depends on how the volume profile unfolded. It's more important now than ever because it's machines trading and they're very consistent with their decision-making process. They call it AI. I call bullcrap on that one. AI is, to me, I'm an engineer, so to me AI is when you tell a machine to do something and then do it better, and then it decides on its own to go learn French in order to do it better. That's AI. For me, learning the range and expanding the range is AI light at best. So anyway, back to the point here on Caterpillar. First of all, why are they shorting? Their best answer to that is why go long? And that's the thesis, basically, why go long? Why stay long Caterpillar? I could ask the same, why go short? So if you don't know fundamentally why go long or why go short, then you should rely on the charts themselves. So let me revisit the fundamentals so we can. So 11 PE, 12 PE. Okay, so it could be a value trap. It sells 1.2 times sales and 5 times book. Not expensive from an absolute basis. Okay, so let's go to a daily chart. Let's go to 1 year. So this is a chart that shows it's skirting with some sort of a neckline that I'd drawn as a potential head and shoulders, but I think we'll go on a weekly and see where okay, so now we can see this is a 5-year span of Caterpillar. I had this red zone because I bet you if I go to a monthly, we'll even see even more clarity. So I'm going to take out all the drawings. So clearly I can see some things here. Let's see here, mark it up. Now this is every tick, every candle is 1 month. This eliminates a lot of the noise. So these are the 2 lows we've had. And look how nice and neat it is with this 2014-ish, whatever happened here. And how nicely this is. So I can say that this was resistance again here, big time. And then right here, they took it out, and then support since then. So right here, onus is on the bears to take it out, right? So if you're a Fibonacci guy, this eyeball, this is the zone of 50% of this extension of rally. Okay, so eyeball from here to here, 50% somewhere around here. And look at this, similar situation. Resistance, like these 2 places, breakout, proven support, okay, failed here. So depends on the time frame you're looking at. The chart tells you different stuff, but right here for sure on the monthly, the 110 is solid support until it's not. So that's statement number 1. So this way, if you decide to short it, gauge how far you want to chase it or where to start shorting it. Let's go back to the weekly and see if we can start getting smarter about it. This is that 110 line we just talked about. Clearly the whole zone here has been pivotal. So this is where volume profile matters. So this period of time from here to here is about a year, and it's a daily candle. Weekly candle. It's about 5 years. Is it? Yeah, 5 years. So 2015 on here. So the volume profile I was speaking about is important from this perspective, right? It's this highlighted zone here is where the value area has been. This is past data. So this is where bulls and bears, buyers and sellers, I should say, fought it out the most, with this being the most fought out over price. So clearly, if this fails, this would be like an immediate target, in my opinion. Also, it's like an inverse cup and handle. It's a neckline that if lost, it should be about this much downside. You know, depends on where you draw it and how you draw it. I'm not a technician, but this is how they think. All right, and they're a little more precise than my giant, crayons. But the concept is solid, I promise you that. So now they're falling into the value area. Usually when you clear a value area over here and you come back to it, it provides some support. And it's not a hard line in the sand, it's the whole zone. So usually the value area is a range trading thing, but once they break above it and come back to it, it should provide some support. Okay, so this is where we're at. They're coming back into this value area, and it should provide some support. Again, it's not a hard line in the sand, it's some sort of a cushion. All right, so my beef is why short it? Why go long it? Why short it? The question could be asked a different way. So I would have to do homework and find a reason to short it. If the markets are higher, is this going to be lower all by itself? No. Then why are you shorting it and not the markets? If they were so convicted in their short, then why don't they short it outright? Instead, they dink around with the options market. So to that, they chose to short it via the options. Okay, let's say I agree with them. They chose to do I believe, a put calendar of sorts. So my beef with that is, if indeed it's got a big time fall to do, then the put calendar would, if you're lucky and you wake up and it's down 20%, you lost money. Because the put calendar will put you long and short at exactly the same time, and the cost of entry is lost money because you don't make any money. You're short and long at the same place. It's great if you can time it to where they place the put short. So even if you get slammed, you wake up one day and Caterpillar is perfect, a huge drop, you made no money. I mean, how frustrating it is for you to guess the timing and guess the direction and then fiddle around with a put calendar. I would buy naked puts if I'm convicted, or I would do a put diagonal. So what's the difference? I guess this would be the quick lesson. Nothing quick about this video anymore. I thought it was going to be 4 minutes. Okay, so what's a put vertical is when I buy a put and then I sell a put lower. I pay X. If it goes through this, both of them, I make my most money, which is the width of the spread minus what I paid for it. Easy, right? All right. So the put calendar is something different. Is when I buy a put, say 2 months out, and then I sell a put, same level, shorter period of time. This is where I anticipating them doing this and then falling. But what happens if it does this? I lose money because I'm long and short at the same place, and I mistimed it. I guessed right, and I mistimed it, and I lost money. All right. So how can I fix that? If I don't want the first scenario, and the second scenario could blow me out, why not I buy this one 2 months out, and then I sell one lower, shorter period of time. So if I time it perfectly, sweet. If I don't, and we wake up to a crash, I still make money because I am shorted up here and long it down here, so at least I have some differential in order to at least break me even, if not make me money. So either break even or make money versus the calendar. So what's the difference between the put calendar and a put diagonal? Just that, diagonal. This is a put calendar, same side. This is a put diagonal. See how it's diagonally. It's not the same level. It's the same stock. Ticker, could be a company, could be whatever. But I buy one and I sell one lower. So I'm guaranteed profits in case it falls to zero and when I wake up one day. So beef A is that they don't bring volume into a decision-making process, and beef B is the way they do it. Okay, once you decide to short it, pick a better strategy than a put calendar. So that's my personal opinion. And also, for me, I would need a thesis to short it. So why am I shorting it? Because why am I not shorting it? That's not a thesis for me. So anyway, maybe I misunderstood their entry point. Maybe somebody sees this and they come back and say, you're an idiot, you didn't watch the whole show, whatever. So I tried to watch as much as I could stand.